Welcome. As a wealth advisor, my primary goal is to help you achieve your financial success through a holistic approach that really covers various aspects of wealth management. Today, I really want to be discussing some critical topics that can significantly impact your financial future. So let's dive in and start with economics and stock market risks. Let's start today talking about CPI, or the Consumer Price Index. Now, it's like a thermometer for inflation, and it really measures the average change of prices for everyday goods and services. When CPI goes up, it indicates rising prices across the board. Now, on September 13th, the latest CPI report was released, and it showed the prices have continued to rise. Now, this reflects the environment we're in, characterized by slowing economic growth and an increasing inflation. Now, it's essential to keep this in mind as we navigate your investment strategy. So let's shift our focus then to the industrial production. Now, this indicator measures a real output of goods and services by factories, mines, and even utilities in the United States. And it's a gauge of how well the manufacturing sector is doing. Now, just like the CPI report, we got the most recent industrial production report on September 15th. And what it showed, that it revealed the production levels have increased slightly. Now, last aspect that we're going to be getting to here in a couple weeks, the PCE report. Now, this stands for personal consumption expenditures, and it really is predicted to show a slight increase in the expenditures as well. So here's the thing. We're continuing to see this lead 3 environment that's really being characterized by slowing economic growth and increasing inflation. Now, the most recent reports have really confirmed this trend, and we're expecting more of this in the future. So really what's happening here is that this is really reinforcing the inflation is going to be stickier for longer, and it's going to be reinforcing that the Federal Reserve is going to keep the interest rates higher for longer. That leads us to portfolio changes. Let's talk about portfolio adjustments that we're making to enhance returns and boost financial security. Now, we're diving into the world of short-term bonds. Now, I've said before, and I still stand by it, that bonds are not a great place to be invested for the most part. You see, that has been the case up till recently, but now things are starting to change. Yes, we still don't want to be invested into 10-year, 20-year, 30-year government bonds because they actually have significant risk still with losing the principal or losing the money on some of these ETF and bond funds. But the short-term 1 to 3 month bond funds can actually contribute to your wealth enhancement strategy. Now, these bonds are known for their relatively short duration compared to longer term bonds, which actually make them less susceptible to interest rate fluctuations. And the short term bonds offer higher dividend payments primarily because of the prevailing high interest rate environments that we're in. So in essence, think of it as a way to capitalize on the current interest rate climate here. Well, we're strategically allocating a portion of your portfolio to these 1 to 3 month type bond funds. And it's a move, again, really designed to provide those dividend payments that are coming in that are higher than what they have been in the last number of years. So what this can do then, it can help overall increase your returns is what we're hoping for. That leads us to wealth management and advanced planning. We've been exploring the world of really wealth management recently as it pertains to direct indexing. Now, this strategy we've talked about before, but I want to continue this discussion because a huge shift that has been made with respect to the technology that's coming out to allow this to happen. Now, we here at Lions Wealth are one of the few firms that can help with this. So first of all, let's take a step back and figure out how it works again and the practical applications that we can have. So let's take a look at, say, stocks like Medtronic and 3M. Well, here we go. First of all, let's get a comprehensive understanding, like I said. So what we're going to do is take a look at direct indexing with respect to all the different aspects of how it can work with trying to sell off some of your Medtronic shares or 3M shares that you've appreciated and accumulated over the years. Now, this is a sophisticated investment strategy, really, and it involves owning individual stocks directly instead of things like mutual funds or exchange-traded funds. And it's a way to tailor your investment portfolio to your unique financial goals. So here's how it works. We directly invest into these stocks. But what we do then is create a custom portfolio that reflects your specific preferences. So if we want to align your investments with companies that prioritize sustainability, ethical practices, we can do that. So we can cherry pick those types of investments. But now we take, say, shares of Medtronic or shares of 3M. They've appreciated over the years. And that creates a selling nightmare. Because with highly appreciated stock, we have tax bills. Well, what happens here with direct indexing is it's a method that we can sell these shares, and we sell them on a daily basis, ones that are showing capital losses. Well, what we then do is offset the losses with the gains. So we can be reducing your overall concentration to these highly appreciated stocks, and we can provide diversification while minimizing or even possibly avoiding altogether tax obligations. So the goal here is to tailor your investment precisely to your needs. Yes, but what we can do is invest into different types of stocks that will reduce the overall risk, especially concentration risk, while we are selling the highly appreciated stock like Medtronic, 3M, or even many others. And we can do this without having possibly any tax owed. That's the power of direct indexing. And that leads us to our second opinion service. I want to remind you of our valuable second opinion service. And this service extends beyond just you. It's an opportunity to help your friends and family, co-workers even, to gain clarity on their wealth plan. Now, if you have, like I said, friends, families, co-workers who could really benefit from a comprehensive evaluation of their financial situation, please let us know. We're here to guide them through a discovery meeting where we'll assess where they stand financially. This discovery meeting then serves as a starting point for a thorough examination of their wealth plan. And it's a chance for us to identify strengths and areas really that need attention. We call those gaps. Now, there are three possible outcomes from this meeting. First off, it's actually possible that everything is in good order and no changes are required. In such case, your friends and family can really continue with their current wealth strategy knowing they're in a good spot. The second outcome then could be that there might be a few adjustments that they could easily make and implement on their own. Now, we'll tell them that and really provide them the guidance to make those changes. Third one that we can be looking at then is that maybe we actually do uncover some significant gaps or even some opportunities for improvement in their overall wealth plan. In such case, we'll tailor strategies on how to address and really effectively eliminate some of those gaps. And it all ensures that everyone's financial goals are on the right track. So with that, I want to thank you for entrusting us with your wealth management needs. And remember that we're here to provide expert guidance and support you wherever you need it. Take care.